This episode of Stock Club is brought to you by Hyundai. Restart your journey towards a greener world with Hyundai's next generation of zero-emission cars. Find out more about their range of electric vehicles and the savings they can bring to your company and employees at Hyundai.ie. Hi there and welcome to the Stock Club podcast. I'm James, and with me this week is MyWallSt co-founder and chief investor Emmett Savage and our head analyst Rory Cowan. In this week's episode, we're talking about Teladoc and Livongo merging to form a digital healthcare giant, which of the big tech companies should be most concerned about the antitrust hearings, and the lessons we can learn from the Dotcom Crash. So guys, we opened the show last time with some great feedback about the podcast and in particular some great compliments about the host's accent. Rory, I know you were a little bit sceptical about who the host of this show actually was, but you'll be really glad to know that the same listener got back in touch with us after the last episode to confirm that they were, and I quote, absolutely talking about James.
Okay, yeah. I saw the tweet. Look, there's no accounting for taste, I suppose, you know.
I was actually thinking afterwards, this is probably the very first time a man from Kildare has ever been complimented about his accent, so I'm taking that as a win for me.
Yeah, it's definitely the first time for everything.
So we've lots of things to get through on today's show, but let's first come to probably some of the biggest news from this week, and that is that Teladoc and Livongo are set to merge. For those who might not know, Teladoc is one of the largest virtual healthcare companies in the world, while Livongo is a company that uses data to provide healthcare solutions for those living with chronic illnesses like diabetes and hypertension. On Wednesday of this week, it was announced that the companies had come to an agreement which will see Livongo merge into the Teladoc brand. Livongo shareholders, who have already had a really good year this year with the stock up close to sixfold before yesterday's news, will receive roughly 0.6 shares of Teladoc for every Livongo share they hold, as well as a cash payout of about $11.33 per share. Rory, I'll come to you first on this. Teladoc is, I think it's the second or third most successful stock pick in the MyWallSt shortlist to date. What do you think of this deal? Is this good news for Teladoc and Livongo shareholders?
Well, I mean, first of all, I just think it's incredible, isn't it, that this kind of small telemedicine company that we brought into the app, 2-3 years ago now, is now involved in the third largest acquisition of 2020.
Yeah, just this morning we were writing about it and I saw our colleague Jamie wrote that before the coronavirus pandemic, both companies were worth a combined $10 billion, and yesterday Teladoc acquired Livongo for $18.5 billion.
Yeah, look, I mean, it shows the rapid rise both these companies have had. I think over the last 12 months, Teladoc stock is up about threefold, whereas Livongo is up about sixfold. You know, these companies have been on incredible runs recently. And it was a shock. Like, this was shocking news. Emmett, you sent me the WhatsApp of the story, and I was just like, oh my God, okay, like this came out of nowhere. There was usually you kind of get some sense of kind of chatter, but this was two businesses that one of them was obviously in the showroom. Another one was we were keeping a close eye on. James, I know you pitched the company a couple of months ago, and we should have listened to you back then, I suppose. But
well, I didn't want to start the podcast off with two boasts, but
well, I mean, like it's so rare that you pitch anything decent. So
what's that about a stop clock?
Yeah, stop clock. Look, you know, when mergers happen, I think the initial thing is always to have a massive dose of skepticism about them. That should be your default position, because the vast majority of acquisitions turn out to be disasters, or at least are dilutive to shareholders. There are a couple of companies we know that are very good at it. I think PayPal is the one we constantly mention. They're great at those little bolt-on acquisitions and have a great history of making good moves in the space. Teladoc has as well. You know, Teladoc has a history of good acquisitions and bolt-on acquisitions, and have executed quite well over the years in bringing businesses together. You know, the deal is an interesting one. It's almost a merger of equals in some ways. You know, it's Livongo shareholders getting about 0.6 of a share of Teladoc plus about $11 in cash. It's already been unanimously approved by both boards. It should be completed by the end of the year. And, you know, just going back to that, the speed at which these companies were growing, you know, visits in the second quarter for Teladoc, which they released just last week, were up 203%.
Wow.
That's amazing. Incredible. And like, obviously we're in special circumstances now with coronavirus and people wanting to stay away from doctors' offices. But Livongo was equally, in fact, growing even faster. This was a company that was seeing 123% revenue growth, 113% growth in their diabetics patients on the platform. For those who don't know, by the way, Livongo is a kind of virtual healthcare SaaS company. Essentially, it provides hardware tools to let patients to check their blood sugar levels, check their blood pressure levels, and provides kind of coaching services to help them manage chronic diseases. And chronic diseases is a huge market opportunity. They reckon that 90% of all healthcare spending in the US is linked to people with chronic healthcare conditions. There's 147 million people in the US with such conditions, 40% with two or more. And it costs the US economy $3.7 trillion to treat these people. So it is a massive opportunity. And what this does for Teladoc, obviously, is they're trying to grow out a full healthcare platform that can be delivered in a virtual space. And this is just another add-on to that. There's only so much they can do by just talking to patients. They need to get data from patients. And Livongo has the hardware to do that. Livongo shareholders, I have to say, are not very happy about this. There's a couple of very bullish Livongo shareholders on Twitter. Prue Saxon is probably the most famous one, who sold his shares immediately at this news. I think a lot of them are kind of feeling a bit hard done by. They were invested in this rapidly growing SaaS company with 100% recurring revenues, and now they're kind of feeling like they're being part of a larger, slower growing healthcare platform that's not going to deliver the same results. And look, that's probably true. It's not going to grow quite as fast as Livongo was, because they're working off a much smaller revenue base. And that's just the law of large numbers. But, like I said, we've seen great execution from Teladoc in the past in terms of mergers and acquisitions. This is going to expand their addressable market massively. It's still going to be run by Jason Gorovich, who's done a great job. And, I'm a shareholder at Teladoc. I'm holding on to my shares. I think, it's such early days. It's hard to predict what's going to happen with a merger this size. But I think we've got good evidence that it could work out well.
Yeah, as you mentioned there, Rory, shareholders of both companies didn't seem too pleased with the news. Teladoc shares fell 20% on the day by close. Emma, is this something you typically see when there's news of mergers? I know Peter Lynch often talked about diversification, and that, in many cases, when companies buy or when companies acquire other companies, it can actually be a negative thing. We saw that with Eventbrite a few years ago when they bought Ticketfly. Are investors correct to be skeptical about mergers like this?
Acquisitions and mergers are notoriously difficult to make work. So generally what happens when one business acquires the other is that on paper, you can see where you'll take costs out and you'll combine, for example, a single accountancy and finance function, and you'll combine other functions in the business. But in reality, when you go to do it, it's the merging of cultures and the way people interact and work, and usually makes it very difficult for an acquisition. And I think that's what Peter Lynch was referring to one up on Wall Street, that diversification, as he calls it, is the type of growth you really don't want to seek out. Now, when it happens, you have to look at a couple of things. The first is, what is that company's track history of success in acquisitions? And as Rory already said, Teladoc has made a very fine job of its past acquisitions. So I personally don't fear that the business can't make it work. Then, of course, there's product fit. So, you acquire a company effectively if you want to get new products or enter new markets. And what's happening with this marriage today is that Teladoc, in my mind, is way better. It's a better investment, and it's 20% down. I think what we're looking at here is I suppose, analogous to, like, maybe, and this is really stretching it, but when Google bought YouTube at the time, everyone just thought that's a preposterous amount of money to pay for something that's just not really related to search. And there was an awful lot of noise at the time. But in reality, today, those shareholders who feel slightly let down are right in doing so, because what they had anticipated, their projection of the future, has suddenly changed. But I think that those shareholders, either side of the line, if whether you own shares in both companies or just one, if you simply just hold on to your new empowered Teladoc shares, I'm of the mind you're looking at a multi-decade winner, because I think that right now Teladoc has positioned itself to be so far at the forefront of digital healthcare that it really, the second best is quite a long way away behind them. And I suppose in the coronavirus world, the changes that we've all seen, the less we can go and see a doctor in person, the less we can do with strangers in person, the better.
Yeah, I think a lot of the sell off yesterday was kind of valuation based as well. Someone noted that the combined company is going to be trading at a multiple of about 19 times revenue based on 2021 estimates, and that's historically high to what Teladoc has traded in the past. So there was just a little bit of readjustments in the markets. That's a high estimate for any company. You got to remember the company is expecting to grow annual sales of between 30 and 40% for the next few years. So it's not totally unreasonable, but I can see why there was a bit of a sell-off yesterday when they put all the numbers together.
Absolutely. So moving on then. So in the last episode of Stock Club, we talked about TikTok and the pressure it was facing from the US government. In the last 2 weeks, an awful lot has happened. President Trump has threatened to ban the app from the US with almost immediate effect until Microsoft stepped in and offered to buy TikTok's operations in the US, Canada, Australia and New Zealand. This offer by Microsoft seemed to appease President Trump somewhat, although he's still determined that the Treasury Department should get a cut of any deal that TikTok makes with Microsoft. And if the app isn't bought off its parent company, ByteDance, by the 15th of September, it'll be shut down completely. Rory, you made a joke that whenever you go on annual leave or go on vacation, a lot happens. And this is certainly a case of that. Can you untangle some of this mess that's happening with TikTok at the moment?
Yeah, I mean the annual leave curse is still very much strong on me. Not only did they have the antitrust testimonies, but then this whole TikTok thing kicked off. It's been a bizarre few weeks in the world of tech. This is by far one of the most strange things that I've seen happen over the years. Look, TikTok presented a problem for the US. We talked about it during the last podcast about I think a lot of people look at TikTok and they think, oh, it's videos of people dancing and videos of cats talking and all this kind of stuff. And why would that be a national security risk? But it was, if you look at it seriously and think about the way the company operates and think about the laws in China regarding data, you could see the potential for big problems. And I think that's what they were looking at. You have to kind of think of the big picture here and what could potentially happen. There's so many kind of moving parts to this, considering like the relationship that China has had with US tech companies in the past. People go, well, why would you ban TikTok in the US? And then you remember, every single US internet business is banned in China, pretty much as default. So they don't really have much of a leg to stand on in terms of like complaining to the US government about an internet company not being allowed to operate. But first of all, the President Trump asking for the kickback to the Treasury really kind of muddied the waters in this. This is starting to look a bit like a shakedown rather than something that has implications for national security. There were so many options they could have taken in terms of how to manage this, how to ensure that there was more transparency into where the data was going. They could have just, rewritten the rule books a bit to make things a bit safer. Instead, they've kind of gone with this gung-ho, scorched earth policy with TikTok. And Microsoft appears to be the major beneficiary. And, I wrote a piece this week about, Microsoft has spent pretty much since Satya Nadella started, have spent the last 5 years moving out of the consumer-facing market because, in truth, they're just not very good at it. They're bad at making customer-facing products. They're much better equipped to build incredible enterprise solutions business, which has seen the stock go up, I think, 5-fold since Nadella took over. So this is a big kind of U-turn for them, where they're going back into a space that they have pretty much no experience in. They don't have the teams prepared to be able to manage something like this. And that brings up the question, well, why are they doing it? They do have an advertising business. I think people forget about Bing, which brings in about $7 billion a year. Even though I've never met a single person who uses it, but there you go. They have an advertising business, so that there is a crossover there with TikTok, which I think will end up being one of the most successful advertising businesses we've seen in an awful long time. The other reason that they're doing it is because they can and no one else can, which is quite interesting. They are going to, if this goes ahead and they end up being able to acquire TikTok's business, whether it be the whole business or whether it be, as was discussed, the US, Canada, Australia, New Zealand business, they are going to get this for an absolute steal. Like, you're talking about the hottest property in tech that is expected to grow multifold over the next couple of years based on its popularity and its download metrics. And there's pretty much no one else who can come in and take it off them.
Yeah, that was a very interesting point you made in your article, and I'd like to delve into that a little bit more. When you think of potential suitors for TikTok, of the 5 or 6 big tech companies, Microsoft is probably last on the list that most people would think. So why aren't the Googles, Facebooks, Apples, why aren't they lining up to get TikTok?
Well, you got to remember that as this story was breaking, the CEOs of those 4 companies were sitting, or well, they weren't sitting there, but they were virtually sitting in a congressional hearing about antitrust and anti-competitive behavior. So, I mean, Mark Zuckerberg would absolutely love to buy TikTok. He would fall over himself to buy it, but he can't. There's no way that they will allow Mark Zuckerberg to buy TikTok at this point, considering what's going on with antitrust. Google's in a similar position. They're getting questions over YouTube and their practices. I reckon, Amazon, they've never really had any interest in the social space. They have a big interest in the advertising space, but I feel that Bezos is very much trying to keep himself under the radar while they slowly creep into the healthcare sector. And Apple, Apple could be a great suitor. I think TikTok would kind of fit into Apple's business quite well, but Apple has shown over the years that they really have very little interest in advertising. They didn't really attack podcasts. We see how Spotify's done over the last few years, taking on that space. Their previous ad businesses were they didn't really commit too much energy to them whatsoever. So yeah, it looks like Microsoft is really the only one who has the pockets and the interest in buying it. Yeah.
And another question I kind of had when I was reading this story is, why is ByteDance so willing to sell TikTok that easily?
Well, the thing is, we don't know they are. ByteDance have come out and said, this all seems like one side of the conversation. It's like someone coming up to you and saying, "Oh yeah, we're getting married next September," and the fiance knowing absolutely nothing about this. There really does seem to be an element of like this is all happening on the US side, with all the US parties kind of coming to an arrangement that ByteDance seem to be. It's ByteDance and the Chinese government, by the way, going, hold on a second, what do you know? That's not happening.
Sorry, Roy, but it is quite interesting that yesterday, I think it was, or the day before, Instagram launched its TikTok competitor Reels. So they've obviously been building this for a while, and it's a kind of speaks to what James was saying about like how Zuckerberg and co would love to own TikTok, but the acquisition would never go through, so they're going to give it a shot themselves. And they've worked the numbers. They know they're going to get X tens of or even hundreds of millions of users and hurt TikTok somewhat. And then it kind of brings you right back around to Microsoft's motivation. And I think it was New York Times during the week I read said that, Microsoft, have a history of acquisition in the social space with LinkedIn at 26 billion, but it was the reliably sober platform is what they called it. And now they suddenly have to figure out how do they deal with all the headaches to go with one of these fast moving social media platforms and everything to do with the freedom of speech versus saying things that might offend people in the highest of places.
Wasn't there a rumor last year sometime that Microsoft were going to introduce like a stories-like feature on LinkedIn, so that on your LinkedIn account you could like have like visual stories, and it just sounded like the seventh circle of hell to me. So please,
LinkedIn already the seventh circle of hell. So
So my biggest fear personally is that they somehow try to integrate TikTok into LinkedIn and just create this absolute Frankenstein monster.
I read yesterday somebody did a back of the envelope calculation saying that off the back of the announcement, Microsoft's market cap was up 80 billion off the reports of buying TikTok, and even on the expensive end, that means they can acquire TikTok and still net 30 billion in new value. So in the
Wow.
flash
That's
analysis, I know it is incredible. It's very hard to it makes sense of it all. Well, for me, as in to see a new platform garner, what is it, 700 or 800 million new users in no time at all is quite incredible, and I guess that's what they're all vying for at the moment.
Absolutely. So staying with big tech then, and Rory, as you mentioned, it was a historical day in Washington last week when the CEOs of Apple, Amazon, Facebook and Google all virtually appeared in front of the House Judiciary Committee to face questions over alleged antitrust practices within their respective companies. The hearing lasted for an exhausting 6 hours and almost 220 questions were asked by both Republican and Democratic representatives. In an article written by Casey Newton of The Verge afterwards, he compared the hearing to the feeling of endlessly scrolling through a social media feed, questions jumping from one person to another and nothing of real value actually being learned. We're going to talk about the Amazon portion of the hearing in the Jargon Busters section of the podcast, but I'm curious to hear if there were any other parts that stood out to you, Rory, as very important kind of for investors in these companies to tune in on.
I mean, Casey Newton said it quite well. I tried to watch it. It was a real circus. These hearings have really become like a joke, really. At times, you can tell that the people asking the questions have been schooled quite well by their aides, but really have very little knowledge of how tech works, of the implications of acquisitions, the likes which we saw with Facebook and Instagram. There's an awful lot of petty cheap shots being thrown around. The Democrats, for their part, were obviously very angry about the Russian hack and how that influenced the last election, made those feelings very clear. The Republican side of the House was going heavily against Facebook and Google and Twitter, strangely, who weren't even there, about censoring right-wing opinions on their sites. Google, we could go through this. There was a huge amount kind of happened of what I think is going to end up being quite little relevance. But at one point, Mark Zuckerberg did get caught admitting that Facebook had bought Instagram in order to quash them as a competitor, which is very anti-competitive, and he could get in some trouble over that. One of the weird things was that Apple made some very good points. Tim Cook, I think, defended himself very well, even though he was hit quite hard about the fact that Apple kind of seemed like a strange person or a strange company to be there, given that they don't even own the majority share of the smartphone market. And Tim Cook made the point for a good few times that they're not about being the biggest, they're about being the best, and that's why they are so successful in what they do. If I was Google, I would be quite worried. It came across very clearly that Google has very few friends in that committee. They were being attacked from all sides on multiple occasions. A lot of it related to the fact that Google had pulled out of a number of government military contracts that they didn't want to be part of. So that was kind of that whole kind of boycott of those military contracts was started by employees, and there was now the Republicans were asking questions about is Google anti-American? Does it want to help China versus Google versus America? Some very kind of wild accusations being floated around, and it became quite clear that there was no one in there that was going to come to Google's defense at any point, and that they could be probably the ones slapped hardest when this does eventually come to action being taken by the committee. Yeah, look, it's funny. We don't know what's going to happen from this. It's all very much showboating for an awful lot of it. Again, like I said, people don't really, the implications of what is happening is very much misunderstood by the people asking the questions. And they really do need to kind of switch these to a format where you have experts who know about this. If you could get someone like Ben Thompson from Sotechery up there grilling these people, you'd learn an awful lot more and you'd end up with much better results. And, antitrust is incredibly important to the tech sector. The entire tech sector is built on antitrust. It's built on breaking up massive monopolies and letting smaller companies innovate in the space. And you think of everything from, the personal computer to the internet to GPS, smartphone technology. This has all come about through antitrust and through the government stopping one company owning the entire space. And so this is a good thing. It should happen. We want to see companies being broken up. We want to see non-anti-competitive behaviors and companies being held accountable when they do break the rules, which it seems like a lot of them are.
Absolutely. So what do you think the chances are of Facebook being forced to sell Instagram? That's the big question, I think, on everyone's lips.
I wouldn't like to bet on it. I do think they're going to have to be very careful of how they proceed acquisition-wise in the future. Even what I saw them do with Reels, Emma, you mentioned that they're actually now. There's reports that they're paying some of TikTok's most popular users to switch over to Reels. Wow. Now, like, if that's not anti-competitive, I don't know what is. They're walking a very fine line. I don't know. I mean, the thing is, if they split up Facebook and Instagram, it would be accretive to shareholders. You would have two very, very successful companies. I think Instagram could grow faster than the native Facebook platform if it was an individual company So, if you're a shareholder in Facebook, you should probably be hoping that these things happen.
Yeah, absolutely. It's a good point. So let's take a look then at everything that's happening in MyWallSt at the moment. So we're at the start of the new month. So that means we also have a new stock of the month selection. August's pick is an e-commerce company you might consider as the complete antithesis of Amazon, but its growth over the last few months has definitely been something to get excited about. Of course, a new stock of the month also means a new stock of the month podcast. Remember, this is an exclusive show that you can only find in the MyWallSt app, where Rory and I chat about the most recent stock of the month selection and go into much more detail on it. Members of the MyWallSt community will have access to this podcast on Monday, August 10th. However, if you're not a member of MyWallSt yet, you can get a free trial of the service and listen into this podcast and all of the rest of them by just clicking on the link in the notes for today's show. Let's go on to Jargon Busters then, and Emma, I'm going to come to you first. This is actually a question I know you've answered a few times, but maybe with the current market conditions, it's worth revisiting. Taylor Stafford on Twitter asked you about your experience as an investor during the tech bubble and the lessons you learned that could be applied to the current market right now.
Yeah, so the tech bubble had its 20th birthday this year, and despite that, I remember its phases, the kind of stages within that event very clearly, as if it was only last year. So I guess, being as I spoke about it before, I thought I'd just take a slightly different angle and describe how I recall the events, and I'm going to describe, I suppose, 4 chapters or 4 forces that in hindsight were very clear. And I think I can see certain elements of them in existence today. So the first force that was in play in the run-up to the year 2000 was revolutionary mechanics, is the way I'm describing it, or in other words, online brokers. So there was this new machine available to every person which allowed them to participate in the stock market. And in fact, while I think most people today think of Robinhood when they think of zero commission brokers. There was an online broker with zero commissions years ago called Zeco, and they were zero commission. They had the same promise and the same functionality as Robinhood, slightly less elegant to look at. But, these revolutionary mechanics were in existence in the run-up in the late 90s. So late 90s, early 2000s, that online brokers suddenly made stock investing available to everybody. And when you look at today, the equivalent is, of course, in-app brokerages, and Robinhood is the great big example of today. And retail investors, I believe, have so far accounted for about 25% of stock market activity in 2020, which compares to about 10% last year in 2019. So retail investors, there's a body of heat there, which is being generated by a couple of different forces. But in essence, what we're looking at in the year 1999 and in the year 2020 is, let's call it revolutionary mechanics, which is the ability for every person to do what they feel like when they feel like it. The second thing on the run-up to 2000 was a theme. And the theme then was the internet. And I don't really need to rake over that. Everybody knows about the tech bubble, or at least has read about it and has lived through it. So everyone knows that internet businesses were on the rise in late 90s and had their day of reckoning starting in around May 2000. And today's theme is coronavirus. And although it's obviously a very, very different theme to the internet, where some of the greatest businesses of our lives are being conceived and built, there is somewhat a lot of energy going into stock investing, which is being in part fueled by coronavirus, more people at home, more time to think, more time to use these new revolutionary mechanics. And according to the New York Times coronavirus tracker, at the moment there's 27 vaccines in human trials. And the share price of all of the publicly listed companies that are even approximately aiming in the right direction at a cure has soared on the belief that they will succeed. And if when they do, the economics that follows will result in an untold riches. So there's been a divergence of optimism and realism, certainly in the vaccine market. And well, the bad news is that of the 165 or so companies in the category of coronavirus cure, the probability that any of them will succeed is actually quite low, which is not good. I mean, when you look at the chief medical officer of Moderna sold all his shares last week and the share price barely moved. And that's an information-laden trade, if you ask me. So here's a business that the world is getting behind because we all want one or more of these companies to succeed. But what I see is a sectorial bubble for sure. Like I just see that certainly in the field of vaccines and that specific, I suppose, segment of vaccines and cures and therapies, there is a bubble because not all of these businesses will succeed, but they are all priced as if they will. So that to me is the parallel of the theme of 2000. So first, as I said, was revolutionary mechanics. So we now have our brokerages, zero commission on our phones, and a theme which, whether you agree with me or not, is kind of fueled by coronavirus. The third of four is discussion forums, which have a propensity to fuel groupthink. And back in the year 99, 2000, Yahoo Finance was the place where all stock investors went to converse with each other. And today it's Twitter. And both Yahoo Finance in 99 and Twitter today offer massive value and huge information sources. But they also are dangerous traps, because of groupthink. They both have trolls, had trolls. I remember in 99, you'd have somebody just do nothing but create angst and noise and voices of dissent. As they do today, but effectively there has always been a place for people to go to voice their opinion. And I don't know if Rory or James, you detect this, but there's far, far, far more discussion and conversation going on about stock market and Twitter now than I think at any point since we founded the business. So I just think Twitter is hotter than ever. So there's heat going into the discussion forums, which I suppose has the propensity to fuel groupthink. And the final of four themes that I see in parallel between 20 years ago and today is that there are diamonds in the mud after the landslide. Like, for example, Amazon floated in and around May 1997. So whether you bought at its IPO or at its dot-com peak or after the dot-com meltdown in 2001, your thousands would now be worth millions. So if there is some kind of downturn, and you know what, I've no evidence that there will be a downturn. You can harbour an opinion based on data points that there might be a downturn. But if there is a downturn, there will be diamonds in the mud after the landslide. And they are kind of the four, I suppose, parallels that I just tried to pull out to give a different angle. So revolutionary mechanics, a theme, discussion forums, and then knowing that quality businesses are absolutely out there today. And if there is a downfall in stocks on the whole, we will just be able to buy some of the world's greatest businesses at discounted prices.
Absolutely. That's really helpful. Thanks, Emmett. Let's move on to the second question then. And this comes from Franco Wong. Rory, I'm going to throw this over to you. And this is about Amazon and their antitrust showing. And Franco asked, how do we think antitrust laws would play out for Amazon specifically? In particular focus, I think, on their access to third-party seller information on their platform.
Yes, we learned quite a bit about Amazon's business practices at the hearing, one of which was that, there was quite a few things. One that I thought interesting was that there's the buy box algorithm, which they use to kind of promote products, favors products that are shipped with Prime and Amazon fulfillment services. So as someone pointed out, that pretty much effectively compels independent sellers to use Amazon's fulfillment services in order to get good placement. that could definitely be considered anti-competitive. He was also asked about this using of the seller data, which was reported by the Wall Street Journal back in April, I think, and Bezos said that he can, I quote, cannot guarantee Amazon employees to not use the data about of independent sellers to create the company's own products. He said that's a violation of the company's policy, but again, he said he can't guarantee it hasn't happened. So, you know, we know it. We know it does. We know that Amazon is watching what sells best on its platform and creating its own basic lines to essentially build up its own retail business. They were also accused of being anti-competitive in terms of the companies they support through the Alexa fund. There was a company called Nucleus which said that Amazon stole its smart display and home intercom concept. So there's an awful lot of accusations lobbied at Amazon. They think they do have quite a lot to answer to. What's interesting, and I'm not an antitrust lawyer of any sort, and there'd be better people to talk to about this, but it seems to me in the past, antitrust has very much revolved around the customer and what makes things better for the customer. So if you're doing something, if it's anti-competitive, they don't seem to really mind that as much, as long as the customer wins in the end, as long as it ends up with lower prices for the American consumer. And, you know, Amazon has a very strong case to say, well, look, you know, we are providing that service. We are taking things like HDMI cables, which typically cost, you know, something like $30 to $40 for one cable, and we're selling them for $10 per cable. So they can make the case that they are driving down prices for consumers. And that's going to be something that any committee hearing or any kind of legislation going forward is going to have to address. Is this, what is the standard now? What are we calling anti-competitive, and what are we saying is going to be illegal going forward? Because Amazon is most certainly driving down prices, and it's going to be very hard to argue against that. So we don't know what's going to happen. Look, like these antitrust hearings, as I said earlier, this is very early days. This is the start of a process that could lead so many different directions. I know Elizabeth Warren's already throwing out some remedies that would not be pleasant for Amazon. But look, we just have to see what's going to happen going forward. As I said, this is the start, not the end of this.
Yeah, and it seems to me anyway that like the immediate focus is on the likes of Facebook and Google. That Amazon might kind of be able to fly under the radar a little bit for another while in terms of anti-competitiveness. There's obviously other issues, but
yeah, I mean, look, the thing with Facebook and Google was that a huge amount of the questions directed at them had nothing to do with antitrust. You know, it was very much about. There was questions about tampering of the elections. There was questions about the Google and, as I mentioned earlier, its relationship with the U.S. military. So a few people forgot that there was this hearing was about antitrust and anti-competitive behavior. But you know, if you think about the upcoming election, you can understand that the focus on Facebook and Google and Twitter, I suppose, is much more pressing than the antitrust elements.
Yeah, absolutely. Thanks for that, Rory. So let's move on to the elevator pitch then to finish out the show. So Emmett, a couple of weeks ago, you posted a poll on Twitter asking your followers to pick one of 4 public companies that they think will be the largest by 2030. All 4 of these companies were worth under $20 billion at the time you posted the poll, and they were all pretty well-known consumer-facing brands. The response to the poll was actually pretty impressive. It was almost a completely even split across all 4 companies. So for this week's elevator pitch, I want you guys to pick your favourite of those 4. The 4 you tweeted, Emmett, were iRobot, Pinterest, Peloton, or Beyond Meat. Rory, I'm going to come to you first because I think I already know your answer.
Yeah, I'm going to sound like a broken record. The elevator pitches for the last couple of weeks have meant I think I've chosen Peloton like every single time for 3 or 4 weeks in a row now.
Next week's one will be Rory. Just pick any company that's not Peloton.
Any company that's not Peloton would be a good one. Yeah, look, in case people don't know, I'm a big fan of Peloton. I think it's a brilliant product. I think they're creating a recurring revenue platform that is going to surprise all of us, even with the rapid rise the company has seen over the last the stock has seen since we added it, 3 or 4 months ago. Yeah. Other than that, not much else I can say. I think, as a side one, if I was going to pick number 2, I thought Pinterest had a fantastic quarter. It was July stock of the month, and the numbers coming out were very impressive, beats on the top and bottom in what was a very challenging environment. So I'm interested in Pinterest as well.
Yeah, Pinterest specifically was July's stock of the month, and what is it up now? It's up like 40%, 48% at the moment since we picked it.
Who's counting? Who's counting?
Rory, don't lie. I see the spreadsheets on your laptop and how often you look at them. Emmett, we'll come to you next. Which of those four companies do you think will be largest by 2030?
Yeah, it's funny because I find it easier to select which one I think ranks in fourth place, and for me that would be Beyond Meat, not simply because there's so many other businesses, looking at pea-based protein meat substitutes. And second, I suppose, thing I'd like to consider is the size of the business today, versus its potential growth. So I'm kind of torn between iRobot and Peloton. I think iRobot has for years been ignored, or its true value has been missed, and that is something you tend to see and can go on for very, very many years until it's unlocked. But I agree with everything that Rory has said. I think Peloton and Pinterest have something very unique. They have that they own the space, or at least the mind space occupancy, if you like, for their respective fields. I love them both. So if I had to pick one, I'm going to go with iRobot. Just it's a wild one, but that's 2030. So we're talking 10 more years growth. And I think considering iRobot's current market position and R&D, I'll go with iRobot.
Your Twitter followers don't agree. There was Beyond Meat was the one who came out the kind of marginal winner there. But I suppose if the podcast is still going in 10 years, we'll come back and see how our predictions are.
It's going to be called Badger Watch then.
Badger Watch, yeah. Don't start this at the end of the show again. So that's it from this week's Stock Club. Don't forget about all the great new stuff in MyWallSt at the moment. And if there's anything you want us to discuss or explain on the next episode of Stock Club, make sure to get in touch with us. You can find us on Twitter, that's at MyWallStHQ, or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. Don't forget to subscribe to Stock Club, and if you're enjoying the podcast, please leave a review for us on whatever podcasting platform you listen to us on. It'll really help us out. From all of us here, we'll talk to you in 2 weeks. Happy investing. This episode of Stock Club is brought to you by Hyundai. Restart your journey towards a greener world with Hyundai's next generation of zero-emission cars. Find out more about their range of electric vehicles and the savings they can bring to your company and employees at Hyundai.ie.